Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. Okay, continuing on the first video from the Stocks That Double tutorial lesson here, we're going to be showing you now a couple of different chart patterns that will show up as well when you're running the scans. And they're variations of the same thing, but they'll look different. So let me kind of show it to you here. First off, you'll notice in this particular case, you've got the consolidation base formation here, but it's wider than the previous one. In the first video, we showed you a perfect example, something that would be absolutely easy to spot. And this one is a little bit wider formation here, but it would still qualify. And then when we have the advanced, the breakout candlestick, remember this 224 was the high point of that channel. So when you close above that, which you close at 268, so that's going to be your breakout candlestick, and it's on strong volume, which you want to see. But in this particular case, you only had like nanoseconds to actually buy. Remember, the close is 268, so that's the max you're willing to pay, right? So you need to pull back, you need to be buying at 268 or lower. So in this next candlestick, you only got down to a low of 262 before she took off again. Some cases you're going to miss the opportunity. Now you might have been able to acquire this, but in some cases you're simply going to miss it. Now here's something you can look for as a secondary entry opportunity. Once she's advanced off the breakout point, you're going to have this, note the volume behind it. It's a total accumulation, goes on for 4 weeks. This is basically a month long of accumulation by a group of people. And this basically tells you that all of this is actually the breakout buy point. What you would do in this case, you would obviously not want to be buying here simply because your stop would have to be based on this breakout candlestick. So if your stop is 1 cent below the low and the low point is 193, then your stop is 192. So if you bought way up here, you're risking a substantial amount of money, so you wouldn't be doing that. What you could do is wait for a potential, remember it's potential because it may not happen, potential low volume pullback back into about 50% retracement of the total advance. So you could get that pullback. Then once that pullback at bottom starts to reverse, you could acquire at that point and then have a stop at the same point and look for it to continue to run the rest of the way. Remember, the target is still going to be 268 times 2, okay? That gives you a $5.36 target. All right, you've only seen a high of 484, so if she just kept going, I would just consider this missed. But if she did give me a low volume pullback in here, low volume meaning volume less than the highest point of accumulation, then I would still be considering this as a buy opportunity. But I'd have to see a pullback before that would happen. Okay. It should also be noted that at no point in time would I ever try to short one of these things. If I saw a situation that ran 2, 3, 400% or whatever, I would still not short it ever, simply because this is the most bullish chart formation you can find. And one of the items you're going to be noting later on is the fundamentals behind the company, and I just don't want to be shorting something that's a growth stock that's got good fundamentals and good accumulation. That's just never a good idea. Okay. Okay, in this particular case, I'm going to show another setup here. You got MIPS, or ticker symbols MIPS, or MIPS Technologies Incorporated. You'll notice that the consolidation period kind of has an upward slant to it right through here. Okay, this would also be okay. Basically, you do still have the consolidation period, practically just moving sideways, but you are seeing a little bit of a bullish bias to the support line on the bottom. That's okay too. Main thing again will be the breakout candlestick formation. It's got to be on good volume. You got that, and then you had about 1, 2, 3, about 3 weeks to acquire this, dipping at or below this candlestick's close. And remember, your stop's going to be right down here, 1 cent below the low point of this candlestick formation. And then she took off on rallying to the upside. This one almost tripled. Sorry. You'll notice that she rallied up through here, and then when you were waiting for that target of about $12 a share, 12.50, she blew right through that and started bouncing around. She hit almost 16, bounced around through here. This right here is a signal you need to look out for. It's a very bearish signal in this particular chart formation, and this particular type. It's a very large candlestick formation, some good volume, and it's a shooting star. It's a sell signal. So in a situation like this, I would just be exiting. Okay, once I see a situation that's got a really substantial, clearly defined sell signal, I would just be exiting. The main thing for this video here was just to show you that sometimes the consolidation or base formation can have an upward slope to it as well. Okay. Okay, another telltale sign you got to learn to watch out for. First off, when you see this consolidation period, I like to see at least 6 months of this. We've got plenty right here, so this is fine. And again, it doesn't matter if it's only at $1 a share like it is in this case. If you're comfortable with trading that kind of a stock, it still works as long as the formation is there. Okay, you got the breakout rally point on strong volume. You want to see that. All right, this is going to be the max you're willing to pay for it, and lower, you got about 2 weeks of opportunities there. Very small opportunities to acquire before she took off again. This one trading at a little bit less than $1.25, so your target will be about $2.50. You hit that target here, and then the following candlestick, though it went higher, it turned around and pulled back down. Here's the thing. Whenever volume, sell volume, is the red stuff, whenever that's larger than the max buying point, the highest point of buying, it's done. It's no longer safe in any way, shape, or form. The entire argument of the trade is because of the massive accumulation. And at this point, you're seeing massive distribution, so you can no longer still be in that trade, okay? That's probably the most important sell signal you're going to find out there. I've seen a lot of times where they'll rally like this and even give a shooting star signal and it'll be fake and it'll just keep going. The main thing is going to be when that volume turns around, I'm done, period. I'm out of that faster than you can blink. Okay, in this particular case, you've got a bit of a wider support base going on here. And the accumulation period went on for about 3 weeks. You started here, here, and here. All right, 1, 2, and 3. The main thing here is the breakout candlestick. Candlestick that closes above the highest point of resistance. That's going to be the defining line for you. So in this situation, you're going to say that this is the max you're willing to pay. And then anything below that is your buying opportunity. So you had about 2 weeks before she took off again. The stop will be based on that breakout candlestick. So the low point here would be about 11.99, 11.95, somewhere there. All right, that's your stop. You'll notice you never triggered it, and up she went. Okay, very easy to spot. In this particular case, the only catch is you need to realize that sometimes price activity, the accumulation phase will be longer than a week because there's a lot of money that's trying to go into these particular stocks. Okay, this is the ones we're going to be looking for are going to have these particular patterns, which are also going to be fundamentally driven. Some kind of a fundamental going on, some news or something is going on that's driving these prices of these stocks higher. And that's the main difference between a pump and dump and a quality long-term buying opportunity here. So we'll talk about that in a bit, but the main thing here is to realize sometimes the accumulation phase can last longer than a single week. It's candlestick. When you're running your scans looking for these opportunities, sometimes you're going to find situations where you had a consolidation period, all right, like so, and then you had the breakout candlestick here, and by the time you learned of it or whatnot, you're seeing this situation where in this particular case you could have purchased here and then traded it to the upside and made the money, but had you come in and the candlestick you'd first seen was this one here, you'd already see this long needle out of the top. That's not healthy. What happens in situations like this is you get the massive spike in price and everybody says the game's over and they get out. If you zoom in on the, remember this is a 1-year weekly chart, so if you zoom in on the not the intraday, but the 3-month daily chart, you'll see that the selling already started. So let me show you that. Okay, this is that same chart. Here's your consolidation period right through here. All right, and you had your breakout right there. You would be doing your buying at about 110 a share. 220 would be the target if you'd done it right. Okay, so that runs back up here about she ran it all to almost $6 a share. But then you notice this massive selling right here. And we scroll down, we look at the volume. You can see that the volume behind this sell-off right here is substantially greater than all the accumulation high point there. So at this point, I would not at all consider this as a good trade in any way, shape, or form. Even if she pulled back down, I still wouldn't mess with it, okay? It's also important to note the only items that I'm looking at on this particular style of investing is price activities, basic consolidation period, the breakout closing above that period, and a strong volume. And I want to see volume continue to drive it higher, but that's it. I'm not looking at, not paying attention to what's going on with the slow stocks, the MACD, anything else. The only thing that interests me is that my stop limit is being respected and my entry point is where it's supposed to be. Okay, now you know. Okay, the last item I want to show you is a pump and dump. It looks the same way. You've got a situation where you've got the consolidation period going on. You've got all that in line like it's supposed to be. You've got a nice advance closing above the consolidation high point resistance up here. and you've got it on strong volume. Everything looks right, and it turns around and just kills you. All right. First off, the first thing to learn here is that no formula is absolutely perfect. There's going to be situations where you just, by no ability of your own, get a bad trade out there. It's just going to happen. The number one thing I can say about this, the difference between a quality opportunity versus a pump and dump, which is what I would call it, would be the fundamentals. Got to have something actually behind the company driving it higher. Now, if you don't understand fundamentals that much, or you don't know anything about them, you can start learning immediately. And the first thing you want to do is study those who are good at what they do. First off, I'd go after Buffett. All right. If you go to our free website at perfectstockalert.com, let me show you this. Okay, on our free website at perfectstockalert.com, you go into the video chart school section. There's a bookstore right here. This bookstore, you can get the information probably anywhere, but in here I have recommended a couple of books, and they're important to me simply because they cover fundamentals, which I find to be important in the analysis that we're doing right now. So these two books right here, Buffetology and The New Buffetology, are the top two recommended books that I have. They're very simple to understand, fundamental concepts that you can apply every day. Okay, so I recommend these two books. You can purchase them right there from Amazon.com. All right. A quick look at our disclaimer before we get started into video series number 3. We will actually go into the details of the scan, show you how to use it and where to use it. I'll actually give you the scan itself as well. So hope you're enjoying this series, and we'll get on to the third video.